Well, welcome to a new trading video. In this video, we're going to cover impulse moves. Specifically, I'll break down how I look at impulse moves. I'll share some tips and advice on using impulse moves within your trading. And of course, we'll talk about what an impulse move is. This is a phrase that I use in my Discord group quite a bit. It's also something that I probably use in a lot of my videos. So I figured I'd provide a little bit more context on how I look at impulse moves and how they inform my trade decisions and how they play a component within my trade system. Now in this video, we're going to cover multiple markets. So we'll jump in and we'll start slow. We'll just cover the concept of what an impulse move is, and then we'll dive into some more advanced ways to look at impulse moves. Now, part of this is also talking about that the market moves in waves, and I am a student of the Elliott wave theory. I just don't like it. I don't think that it holds up. And I found when I was trying to use it, I was spending more time trying to figure out the various patterns of waves, where what I'm going to share here I think is just much more easier, much more simpler, and you can knock it out and you can do that. You can see these things in your head and you can knock this out with just simple technical analysis. So when we say impulse wave, or when I say impulse, I'm kind of thinking of a wave, but just think impulse. Think a strong move in one direction or another. So a strong move either up or a strong move down, and it's a sustained move. It's typically started with a very strong bar, but sometimes that's not the case. We'll go through examples of that here. The other thing is that there is some good patterns that you can use with these impulse moves to inform your trade decisions. Now, I wouldn't trade off this alone. There has to be other factors. And if you're in my training, you know the other factors that you would follow for trading off something like this in impulse moves. And in the Forex market especially, this is one of the best strategies that you can adopt. It's a very predictable pattern, but it works in every market I trade. So it's something that you'll see here. We'll go through multiple markets and you'll see what I'm talking about. And that's probably a good way just to start. So let's jump in and let's talk about what an impulse move is. An impulse move is a sustained move. It has a starting point and an end point. The first impulse move that we see on this chart, and we are looking at a stock on the NASDAQ. We're looking at INAP core, and we're looking at the 4-hour time frame. There's no other indicators on this chart except for volume and standard Japanese candlesticks. Now, if you look at this move here, this is, I would call this an impulse move. So from here to here is an impulse move. Now there's another impulse move here. I'm going to outline the impulse moves first that we're going to talk about, because there's multiple impulse moves, but you would grade them differently. You would look at them differently. This is an impulse move as well. We're going to talk about that. And then here is an impulse move as well. So those are all impulse moves. We have one that's a bullish impulse move, one that's a pretty sustained bearish impulse move, and then we have a smaller move within the same bearish pattern of an impulse move. So let's remove that. Let's talk about this first impulse move. So first impulse move, obviously if we go back in time and you see this unfolding, the better way to do this is to use the replay. So let's use the replay and go back in time. You see this unfolding. This is your first sign that there's some type of impulse happening in the market. Now, there's other signs within this chart right here that this probably is not where you want to trade right now. The first sign, and I'll just give this generally, is that this is at a middle of a value range, and that's right where it closed, right at the kind of middle point of a value range here. And if you use support and resistance, you're probably saying, hey, there's support and resistance there. Yeah, there's a resistance area here that was previously broken through. But this is the middle of a value range right here. I can see it. I don't even have to draw it. I can draw it for you if you can't see it, if you don't know what value channels are. This is basically the value range. It's not quite the middle. If I was using this bottom here for like the middle. So if you would do this more traditionally, you would look for price excess here. You would create price excess channels. And then that's kind of what I was drawing. This is, when you look at this, this is price excess. This is price excess. Okay. But this is a pretty strong value channel. It's been trading within that channel for a while, and it happened to stop right at the middle of the channel. So that's the extent we're going to talk about value channels in this video. But I wanted to cover that for context, because this is also why in real time, using something like this, oftentimes it's better to wait for the impulse to unfold and then trade the reaction of the impulse, because we already know what happened, right? But in this time right now, looking at the chart, we would say, well, is this the first part of an impulse up, or is this the impulse that I need to start charting and trading off of if I think that there's a potential, and you would be trading off this on the long side. But let's remove all this and let's just change the chart back to, we can see the future. And here's what I want, here's how to explain the value of looking at the chart in an impulse way and looking at these as one move, because this is one move. This is one of the problems with candlestick charts, is that the mind is tricked by the colors and all the rejections and everything else. This isn't one of the best ways to look and say that this is messy, but this section here, because it's red and it has some retracements and everything else, it doesn't look like it's one sustained move. But let's use a different candle type. Let's use the Heiken Eshi, and I probably butcher that name every time I say it. It's a little bit more clear that this is one sustained move, meaning that it's a positive move up. But sometimes in some of these moves, and this isn't the best one to use, when you don't see the market in this way, it looks like it's not one sustained move. But when you look at just the raw prism of price, if you haven't watched my video on price and why it's the most important thing, through the raw prism of price, if we're using a line chart here, this same time frame, the line chart shows right here that this is the high here. And yeah, it struggled a bit to get there, but this is one sustained move. I'm sure most people get that, but I wanted to point it out. When you're looking at candlesticks, sometimes it doesn't look like one sustained move. When you see an impulse move, one of the best things you can do is, when you have a high that's rejected like that, is that you can start charting. I'm using the GAN tool on this, and you're going to notice a pattern quite often on these impulse moves, is that the 50% mark, the 25% mark, and the 75% mark are reliable areas for the market to find support, and the market to then try to continue the move that this impulse move was flagging. So this impulse move was flagging that it wanted to get to this point, but based on what's happened with the historical action of this chart, and we'll talk about this, it's pretty obvious that it didn't want to go there. But let's say that you're up to this day, you see the rejection and you see the second failure here. This is where, so if we're back in time, and I'll go back in time here, and we're here, you have the second failure right there of the impulse move. That's the second failure. There's failure 1, failure 2. So here you can start drawing real simple technical analysis. The start of the impulse move and the end of the impulse move. What's the first thing we're seeing here unfold in real time? Well, in history, real time? Well, we're seeing it stop at the 25% and looking to maybe create another value channel in this range. You don't know yet. So far, if it closes once again, so it already closed once below this channel, this 25% mark. If it closes once again below this channel is invalidated. If it closes one more time below this is invalidated. The next place you're going to look for, and the highest probability place, is the 50% of this sustained move. But with this sustained move, with this impulse move, I should say, that's not the best area you'd want to look. I'm not just saying that because I know history. I'm just saying that because how this sustained move is currently playing out, in addition to the other price action that I see on this chart. So if we forward this off, we see that, okay, officially this channel is broke. Now it looks like it's going to test it again, but we don't trust it anymore. We don't trust this 25% mark. Once it's broke like that, it's going to break again. Now the 50% mark here, and why is it not stopping? Oh, because I'm recording the video. For some reason, it just doesn't register my mouse clicks as quick. So you'll see here what it did is it did test this 25% mark. I mean, this is good if you get good at doing these type of swing trades. These are good swing trades when you find something that has a impulse move, and then you see that it might be respecting these certain areas on these actual breaks and these actual on a lower time frame. These areas in the price chart, these areas in price on the chart, if they hold up value in certain patterns, they're good to trade when they hold up value among the 50% range. You see here, though, it went back to the 25%. And then as we go forward here, it's going to break the 50. We already know that. But it's holding the 50. It's really trying to hold the 50. It's spending a lot of time. It's trying to hold the 75. Now, on this impulse move, that's so annoying that it doesn't stop. Sorry, it's hard for me to talk while it's not stopping. On this impulse move, another way that you could have used this impulse move when it was flagging, the market was flagging that it was looking for another area. And what was it flagging? This move right here, when price got into this first impulse move. So this is an impulse move. Remember I said this is an individual impulse move. So this bar, single day or single 4-hour bar is an impulse move. And and this total move is an impulse move. But one thing you can do as well when something's flagging that it wants to move into the price of a initial impulse move is you can then take that actual bar there, take the low and the high. And what happened there? So these are my own terms, a lot of this, and maybe I've got it from somewhere else, but I haven't really seen these type of terms. I look at this, and I didn't take the low and the high. The low and the high would be here. But sometimes you will do the low and the high or the close. Closes have precedence over lows and highs. So that's one thing I would say. On most of your technical analysis, close and opens are the most powerful thing above highs and lows. There is aspects of that where sometimes highs and lows have more precedence because they flag something else. But generally, on something like this, if you want the quote unquote in air quotes safest way to do the technical analysis, use the open and close. So here, if we use the open and close on just this bar, well, this price move was flagged when price entered within this bar, within this impulse bar. That was signs to, well, if this looks like it is bullish, I probably should get out of this because especially if this fails up here in this upper range, that the most likely test is the 50% mark of this bar. And that's what it did here. Now the second, see one thing it did here, which is another sign, and this is specific to the markets that gap, is that a gap is an impulse move. So this is an impulse move right here. If you would just count this one impulse move, it never even tried to fill that gap. Most gaps are usually filled, meaning that they're tried to be filled. They're tried to be breached again. It didn't even breach that. So here in this trade, one thing that you'd have to be very mindful of is that in this trade, this overall impulse gap was a risky trade the second that the 50% mark overall didn't hold up. And then here, if you were trading off this, you definitely would have tightened up your stop because you've already broken the rule that the 50% mark of this overall impulse move has been solidly closed below multiple times, has been tested again. Now, if you were in this trade here, so let's say you entered the trade here, I'm sharing deep examples. So this is, I share, you're not going to be trading just around this, but let's say there's other indicators that align that told you to make this trade, and you're looking for, I mean, that's a good day trade right there, 10%. And you have, maybe you're trading, if the channel breaks, you're trading a tight stop loss of 3%. It's a pretty good trade. You could not complain with that type of trade, especially as it turned right away. That would be a good day trade in the equity market. But you're doing that. How are you doing that? What's your analysis coming from? Well, your one analysis is that this is the overall channel. The other analysis that you would be doing potentially is off this individual bar. And you might be entering even at a better area here down below, saying the same type of thing. Well, if the 50% mark of this impulse move holds up, remember this is a range. It's not an exact number. But if it holds up, well, then I enter the trade. My stop loss is real tight because it should either run there or fail. It's really cut and dry. And my target is maybe 75%. Is your target 1, take profit. Target 2 is then the top of this range bar. And it did overextend there. But then what did it do the next day? Is it completely broke? It gapped down. So let's look at that. That's kind of merging a couple impulse moves. And that's how to look at them. You want to see these as one sustained moves, but then the market, and I don't know what to ascribe it to. I'll ascribe it to the moon, if that makes people feel better, because I don't really care. Because the reason why I don't care is because I don't care to figure out why the market moves like this. I try to, but there's so many factors. Maybe people are using Fibonacci. Maybe people are using the same stuff I am. Maybe people are just using raw price and saying that it moved from here to here, and then this is 50% of that, and that's where I want to buy. I've seen all the theories. I've read all the theories. All I do is I do technical analysis. I create a rules-based system around it, and when I see it appear in multiple markets, and it's an edge, and I can trade around it with good risk management rules, and it gives me a positive equity growth, I'm happy. I just like, I'm not trying, I'd like to figure out maybe the true meaning of life. There's answers, love, I don't know. That's the only one I can think of at the top of my head. But I don't care. I mean, I do care. I'm living my life to the fullest. But at the end of the day, I'm never going to know. Never going to know the true meaning of life. It's kind of the same type of stuff for this. So that's my philosophy in it. If you want to understand my philosophy of why I'm not trying to really explain why all this stuff happens, and maybe we could throw some EMAs, moving averages, and we could really sound smart and say, well, you know, when there's an impulse move and then the 50 moving average is here and here and here. And yes, I do use those other things to inform. That's why I'm saying just trading off impulse moves alone isn't a good enough edge, but it does a really good job of telling you where to look at in a chart. It does a really good job of saying that here's an impulse move. Here's where I should look in the chart for trade opportunities. It does a good job for that. So let's finish up this one, then we'll move on to another market. But keep in mind, this doesn't matter what we're looking at. The theory holds the same. Now, one thing I want to mention here is that this is a big impulse move. Big impulse move. Here's what happened in the market. Here's the story of this chart. Earnings, well, there's earnings right there. Earnings came out, and earnings was probably a surprise. It was a surprise. The estimate was negative 64, and the surprise was just 5 cents off. So for whatever reason, that surprised the market, and it surprised the market in the upside. Now, what happened though is eventually it hit 1530, and the market participants in this, you know, this could be Beanie Babies. It doesn't matter. It could be anything. But the market said that, holy crap, 1530, this thing isn't worth 1530. Obviously, there's profit taking, and that's really what's happening. But this thing is not worth 1530. It's just not. There's no way. And you know what? There's no way to the point of this thing is not only not worth 1530, this thing is worth really $4. That's really what this thing is worth. That's what this impulse move from this price has said. This is one move, one decision, is the way to look at this. This is why when you're looking at the historical, and actually it's cheaper than that, sorry. That was what it was worth then. Here, it's now saying that it's only worth $2.83 or so, $2.90. So, but the impulse move that I would trade off of on this is that when it gets to this point and it has these mini reactions, like this is a mini reaction, this is a mini reaction, and then this mini reaction held up. So I'll go through that because that'll be a good place to start this long impulse move, and then we'll cover this sub impulse move. Actually, we'll just cover that one right now because this is obvious because I've already covered it. Well, let's say you're trading this and then you see this big move. This is real simple whether or not you want to continue short. Take this, draw a 50% channel, or draw with a GAN tool, for instance, like I did. What magically happened there? And this is using the open to the low. What magically happened on this? Well, it magically went down, came back up, came to the 50% range and failed. And since then it failed. You pretty much had signs immediately that this was a great short. If you would have took a short there, if you would have took a short like this, so use the short tool instead of the long tool, you would have took a short right here. Your stop loss, 8%. Your target is the bottom of the range. This is a one-on-one trade. Really, that stop is a protective stop. You'd probably do it a little bit less than that. A protective stop, because you're looking at this, you're looking at this impulse move is that it's going to have a further reaction. This is flagging for a further reaction down. So this is my target 1. If you would have took this trade, you would have pretty much been almost in profit. Would have got close to your entry there. But then from then on, this would have been an in-profit trade. And then as it broke the bottom of this channel here, you would have continued to say, well, it's not breaking this 25% mark of this impulse move. And then what did it do? Well, if we use this same impulse move as our decision marker, it's using the bottom of that for resistance. And then it completely broke down again. Would have been an awesome short. Just using this simple strategy. So when you see something like this in a market here, and it's having a strong reaction, this is another impulse move. This is a long sustained impulse move. If we do different candlesticks, you'll see there is retracements, but there's majority of candles. You can say that there's a higher low and there's a lower low on all of these candles. So there's lower lows, lower low, lower low, lower low, lower low, lower low, higher low, higher low, higher low, higher low. So any way you want to describe it, it's unfolding in the market. So when you look at this though, one thing you're looking for is impulse moves. This is an impulse move, remember, because there's a gap. So that's an impulse move. But then you're looking for a strong impulse move to the upside, and it typically is going to be, it's going to stop at 50% of an impulse move like this. Well, you don't trade this typically unless you're trading with the trend, meaning that the trend is down. So the only trade here is you don't long trade this. Unless there's some other scenarios in your trade system that tells you this is where you want to get long. You don't long trade this. You're fighting everything if you're long trade that. If you long trade it, it better be a quick trade. What you do is you look and say, well, this isn't your first entry for a short. Typically, you can do a probe position. Depends on how much you're watching this. But typically what you're doing is you're trading the reaction. So remember, I'm talking about this long sustained move. So you're not just doing this bar. You're looking at a continued. So this already moved at this point in time. It moved negative 57%. You're looking for maybe another 57%, which would be right basically where it stopped. So see that? So if you see this is why measured moves. If you haven't watched my measured move video, you should watch that. Measured move of 57% from here to here. Remember, you're charting from here to here. This is the first other impulse move that you see on the chart, pretty big move. And then you say, okay, well, I want to trade that impulse move and I want to go short because I don't want to fight the market. This one was 57%. Let's go 57%. And let's say you didn't even have this chart. That would be your target. Target would be right there. So you'd be looking at this and you'd be saying 57%. And it eventually got there. Took a while to get there. But here you got close. If you didn't take profit here, don't hold out for 3%. Don't hold out for 2%. If you projected 57% and if it's at 53, it's a pretty good place to take profit. So how would you trade that? Using the impulse move concept that I'm sharing here in this video. Really simple. You trade the reaction. So you don't trade the first reaction. So remember, we're talking about the impulse move here, from here. We're talking about another 57% from here is what we're really looking for. Looking for another 57%. So we go here. There's two ways to do this. You draw the impulse move here. And that just happens to magically line up there. But what you would have here is you would have something like this. And then you draw here. See how it's not quite the middle. See how this is what you'd be drawing, because remember, this doesn't exist yet. We're taking the trade from, we see the reaction here. Let's say, and I'll go back. I don't like going back in history and recording because it doesn't treat it right. So here, this is where we're at. We're in this day. We're just being patient. We're waiting for 50% test of this, and we're going to see what happens. And we might take the first trade because we might take a probe position. But what I would suggest here is that you don't take this first probe position. You wait. And here's maybe where you would take the first position. Because if you broke up this channel as well, here, your best next failure position is here, is in this next channel. Your next failure position for short is there, down to 57%, right here. We'll see if it gets there. Market is messy. Nope, never got there. So then you have to make a decision there. Stop. It does not want to stop. I'm trying to stop it. Okay, so I stopped it. So what you would be looking for here is a retest of this range here, the 50% range, and a failure there. That's like the perfect setup. But the market's never perfect. I wish it was, but it's not. So your trade would have been more like here. The second that this bottom range failed, and this is one of those trades you might have been chasing. If you're not a good trader and it didn't meet your entry here, you'd feel like you were chasing if you entered here. It still would be a good trade, but you'd have to look at your entry criteria and make sure that you weren't chasing the trade and you were still solidly trading your plan. So what I mean by that is that this is hard to do in trading. This is actually good that I have this because this is hard to do in trading. So, and I'm going off on a tangent, I know. My optimum entry is right here. I want to see a failure right at the middle of this kind of range here. That's kind of the perfect. Now, it already did it once. I wanted to see it happen again. It didn't happen again. So at that point in time, I'm saying, well, this sucks. I've been watching this thing. I drew all these lines. I did all this stuff. You know, this is going to be an awesome trade. It's got a 57% potential. And it missed my entry. Completely missed my entry. So then I have to look at the reality of the market at that given time. And then I have to read the market correctly and make sure that I don't just enter right here. And then, because what happens sometimes is that I enter right here if I'm chasing the trade. And what does it do? It goes right to my original entry area. Now, my stop loss is far enough away there, but what bad traders do is that they would have done that. They'd be chasing the trade, and then they'd put their stop loss right where they would have entered before, and it'll hit their stop. And then it'll come back and it'll do what they expect. So what you got to do if you miss something like that is you don't chase the trade. You still look at it from an objective manner. And that's where I'd say, well, maybe I was a little aggressive on my entry, which I'm sometimes. That's also why I enter probe positions. Oftentimes, this is just me as a trader. I will enter here, up here, because I see a failure first of the 50%. Small position so I can watch it more, and I'll get a feel of how that thing is really moving. And then that I might enter then my full position on the immediate failure of the zero line here. And that's where you'd want to enter the trade. Is when it fails a couple times on this, when it just fails and it gets weaker in price action, and then you enter right here with your stop loss above the 50% mark of the next channel, the sub channel. Remember there's a sub channel here. So you don't typically, you can do a tight one, but that doesn't usually give it enough room. You'd want to do something like this. That's even a lot. But if you're looking for 57%, you have a high conviction rate, or you're highly convicted on this trade, then yeah, that's a decent stop loss. It's a protective stop loss. A lot of my stop loss are protective, meaning that if I'm wrong, I'm pretty much wrong, but I'll give it enough room to kind of play around in this range. So then it's there, and this trade did take a while. What did you also get though here? If you would have been a little bit more patient on a time scale, you got another entry area, and you probably started getting worried, especially here, especially as it was, oh, actually, no, it did hit your profit target. It went to 36%. What's my other rule that I share a lot of my videos? When something moves 30%, take profits. That's a kind of standard rule that I follow. If you're in a trade and you've been fortunate enough to get to 30%, take profits. So that's the breakdown of how to trade that. Now, if you look at this, where you're going to start looking for clues of a turnaround is the first impulse move on the upside, but that reaction didn't stand. So this is the first impulse move on the upside. So you'd be looking and saying that this is a bottom. So then you're looking for, is there a reaction from this impulse move? And does the price value of this impulse move sustain? So one way to do that is you take the middle of this impulse move and you just say, does it consistently close above this impulse move? And the second that it consistently kind of closes above this impulse move here is another potential opportunity to go long. You go long maybe on this day here, this pullback day here. And I guess you could say, well, let's go long on the bottom of the last impulse move, 36% move. Or maybe you do a stop loss, something around 6% or something. You're looking to get two open and closed days right there. And you didn't completely call the top here, but it's a pretty good trade. So what was the simple, and I know I've deviated a lot and I shared kind of details, but if you look at this, and this is just one chart, you can do this in any chart. We're going to jump over to BNB here in a second. But so if we go here and just to recap, impulse move. There was an impulse move here, but it didn't hold up. See, 50% of it didn't hold up. It failed. And then it never came back above. There is a little bit of a weak impulse move here. This overall one, this is the other way you'd be looking at this. This is a mini impulse move. So what are you looking for? 50% of this impulse move. Does it hold up? No. It's meaningless to you. So hopefully that's clear. Hopefully that expands a little bit more in impulse moves. Let's go to another chart. BNB, BTC, crypto. We are looking at the 4-hour time frame. Let's look at the daily. So let's look at the daily time frame on BNB, just to do a different time frame, show you that this stuff still works. So let's say, do you see the impulse moves here? I'm asking you like you can actually point on the screen and start drawing. Well, one impulse move, there's a couple. The one that is in play right now is this one here. That's the one I've been trading off of, that impulse move. And the better way to look at it is that this impulse move is from the middle of the range if you want to be safer. And you say, well, why didn't you start down here? I think I'll show you in this chart it doesn't really matter. So I'll reveal in this chart. I don't think it really matters. But I use this here because I like that this is kind of the start of a sustained move that didn't stop. It did stop. It did have pullbacks. But then, and it's holding up from what I'm seeing right now currently in the chart. So if we take this, we go from here to here. I do that wrong all the time. I wish they had dots on both sides of this bar, but they don't. So here, if we use this here, this is why I'm showing you that I have a specific way that I draw these, and I've shared this in many videos, is that your role to become a successful trader is when you're watching my videos and you're watching other videos and you come across an idea that is new to you, is that you either see whether or not that idea has validity. You either believe right now watching this video that this is something that will help you trade better, help you have a better edge in the market. But you don't take my word at face value. This is how you should go through all my training. You go and then prove this to yourself in the market. See if you can replicate it. I'll ask you about support and resistance. Do you believe in support and resistance? Well, have you done enough of support and resistance across markets and everything else that it's actually true in providing you an edge? Or do you just believe in support and resistance because every other trader out there talks about it? And I know that's a very common thing in the trading market, but have you really sat down and done the support and resistance analytics yourself to then make that an idea your own, to then have it become a theory of how you view the market? So this inflection point here, or this, I say inflection point because there's an inflection point here. This aligns with an inflection point. But this here is, the reason why I chose this is because it aligns with an inflection point. It also does a really good job of creating the price channels that exist on the chart right here. And this is another thing where, keep in mind, we're on the daily time frame. So you would be dropping down most likely to a lower time frame for trade entries. But this area right here is the 25% mark. This area right here, now keep in mind, when this high was established and you're using this type of inflection point, or this type of, this type of impulse range, then you're expecting for a 50% challenge here, and there's no 50% challenge. So that might be a clue that, oh, this isn't the best area to use that, because we want to see a reaction at 50%. And where's the reaction right now is here. So oftentimes you can do this and you can say, well, where's the reaction? And then you can go back. And that's why I say it does matter, but it doesn't matter, because I could have started here on this range right here. This overall impulse move and then reaction, which probably is the smarter way to do it. So you see, this is an impulse move. This is the reaction. Impulse move here, here. Where did it hold up? Look at this. This is interesting. This is why when you start looking at the market like this and these overall moves, this isn't exactly perfect, but look at this here. I'll make it perfect. I'll use these arrows in this. Overall impulse move. Impulse move went down, found 50%, stopped there, stalled there for a while. Scroll in. Played around there, found it did what the market what you expect the market to do. I mean, you see some here, it did reject, but it actually closed way up here. Came here and it played around at the 50% mark right here. It played around it, went below it, and then had a impulse move up, and then this impulse move. This would have been another clue here because it's right around. Now you didn't have this. You did have this 50% mark that we're looking at right now, this smaller one. So then you could draw another 50% and say, well, that's an impulse move. This 50% holds up and this 50% holds up. We've got something here. I'm sure there's some kind of witty saying I could say, like we're cooking with Crisco or whatever the saying is. So whatever saying you use to say that you've got a good trade in front of you, use that saying. And then from there, it really did move. I mean, it moved 163%. Not a bad trade. And if you're still in this like I am, then you've stayed through all this pain. You've added some more, added some more, added some more, added some more, added some more. I trade BNB religiously until it breaks down completely. Until I see a series of things, I'll exit everything. I haven't seen this series of things yet. So here, it's up 300%. So if you would have stayed in this trade as a long-term trade, looking for long-term positions, here's another area too, using the same impulse move, the 75% mark, that was time to maybe add your second position. Now it eventually went back and went below that, but maybe you got out up here. So if you see this, when you start seeing the market in an impulse moves and just using simple 4 lines, 25%, 50%, 25, and 0. No magical theory, no magical nature thing that supposedly the market moves. These are very whole numbers, numbers that the smartest trader and the dumbest trader can understand. I'm not calling anybody a dumb trader, but you can know if something's $1, you know what half of $1 is. It's real simple. So something moves in value, the half point, it's just the way sometimes the market moves. The half point is one of those key anchor points you want to look for trade opportunities. So you can do this on any time frame. You can do this on an overall time frame here. You can do this on a smaller time frame. You can say, well, you can do it in real time. This is the current impulse move. So based on this current impulse move in the market right now, where should I be looking for to enter long? Well, we kind of already saw the opportunity to enter long at 50%. If there's strong bull sentiment here, based on just this impulse move, you would probably want to use this. But let's just say you're not using that. Let's say you're just looking at, okay, well, let's look at the latest area of support that was found. And one thing to keep in mind, another thing you can do, and I'm not going to hijack the video here, but when you see areas like this doesn't classify as an inflection point, but it classifies as the market accepting a price. So this middle of this price is kind of the market accepting this price reality. Even though it's already been up higher, it's accepting that this area is a value price. Because let me ask you another question. Using standard support and resistance, and I know some people say you can't TA the crypto market. I don't know, I do it all the time, so you can. But why did it stop here? Using standard support and resistance. But is it stopped here because this is a previous resistance point and now it's support? I mean, why did it stop here? Why did price create a value range of trading over a couple days, and why did it stop here? Now it was pretty volatile, but it's always volatile. Why did it stop here? It's not as volatile here. I mean, you're seeing pretty volatility on both sides here. It's not always that volatile. But why did it stop here and move from here? Of course, Bitcoin has something to do with this. So that's the real answer, is that some of it's part of Bitcoin. But then even if you take Bitcoin out of the scenario, you'll see these patterns time and time again. But you didn't need to really look at support and resistance, because if you would have been using support and resistance, this would have been your support and it blew through that. Where's your next support area? Maybe here? Maybe? That's not a strong support area. It's a strong inflection point. If you've been in my training, you know what that is. So that you would be looking at that. But your next real support area is kind of here. So you would have been waiting for here, or, you know, like I said, it's pretty arbitrary. That's why, like I said, the further I'm moving further and further away from support and resistance in a standard way. I always have not looked at it in a typical way. So I'm moving further and further and away, whether or not that's even the right way to even start new traders at. So it's a concept that's good to know because you do see price action around that area, but it's also not the one that gives you the biggest edge. Okay, let's go to the Euro Japanese. So I already drew some things on here just because I'm doing another video for the Forex training. So here's a prime example of looking at this, of how this works. So we're looking at the daily time frame. This is why this can work on any time frame. Basically, in the video I was doing, I was showing that there's clear opportunities to trade every single one of these. Every one of these greens is a very clear trade signal with simple rules, with very simple rules. So like here, we're looking at the daily time frame, and this is the one reason why trading the Forex market is great, because if we remove all this stuff, this is an impulse move down right here. This is an impulse move down. Right here. Where did it come back to and fail again? That should be so obvious that you're like pounding on the screen and saying 50%. Yeah, did you have to be patient? Hell yeah, you had to be patient. But trading isn't about getting into a trade every opportunity you see, unless you have a trade system like that. Trading is about taking the highest probability trades to protect your capital and to grow your equity. So when I mentioned in a previous video one trade idea, like I said, you shouldn't base your trade ideas around just impulse moves, because you are going to be a little frustrated because it's one component of a very good trade system. But just this alone provides you a pretty good component. So let's say that you see it bottomed here and you saw the pattern that it was holding up 25% of this. See, how you do this is that this doesn't exist. You don't know this yet. So we don't know any of this yet. And I'm not going to use the rewind tool. We don't know any of this yet. So when you're looking at this, you're always drawing the next day low and you're looking to see what's happening. Okay, next day low. Here's my 25% of the current. You're starting here. Here's my 25% that I'm looking for a retest. That's my highest probability trade. All right. Now you would hopefully have a trend trading system as well. And if you're in my Forex training, you're going to get one that would trade this short anyways. But if you're just using what I'm mentioning here, impulse, you're then at every close or every low, you're looking at this and you're saying, where's 50%? And you see if we use this red box as we don't know yet, we don't know yet, we don't know yet. Okay, well, we hit a bottom here. All right, so we're waiting for that 50% here. And then it came up, didn't quite reach the 50%. And you might have been chasing the trade then. You're like, crap, I think I missed this trade. Damn it, is probably what you're saying. But then it came back down and it bottomed again. And then you bottomed, you use your 50%. You have a new bottom. So people that are used Fibonacci's, you're used to this type of thing. So then, what are you doing? You're just waiting. The second that it failed, this 50% is your trade. Yeah, you had to wait, but you have 32 other pairs, non-US pairs to go through. So you have 32 other opportunities there, and then you have the US pairs to trade as well. So you have plenty of opportunities to find something like this. So then you go short. You go short, and you're looking, your first point of failure is here. If that fails, great. Second point of failure is here. When that fails, great. And then you're looking for the big move, which is 800 pips. So That's just using the daily time frame, same simple method that I mentioned. We do the same thing on the upside. Impulse move, and I think you get it by now. Impulse move here is where you'd have it. Because remember, we're going back in history. So this is one sustained move. Let's say you didn't trade it, you didn't see it, you missed it. Okay, fine. We trade the reaction. Reaction is at 50%. So here, it's holding up. It did blow way past it. It came back, eventually held up. And then when it held up and it stayed above that level, it moved to your target 1 for 152 pips, to your target 2 for 287 pips. And then once it kind of moved above that, you'd probably be looking for an exit because that's an overextension of the price value. So then, but if you would do good trade management, you probably would have got out maybe on these down candles here, somewhere around 370 pips. Once again, you're not just trading off this. So this is a good framework. It's not what you're just solely trading off of. So we could go through and I can mark every impulse move here. We could break this down and really talk about but I think I've covered enough examples where you get it. Here's what to do next. There's really two things. If you want to develop your own edge and have a strong foundation and get a shortcut to building your edge in the markets, you'll want to join my training. It's 0.07 BTC. To join, you'll want to join Discord down below. Send me a direct message and ask how to join. It's simple. And it's lifetime access. You get access to my indicators as well. And I add to the training consistently. The other thing is, if you learned a new idea in here, you want to then develop rules around this idea. So if you think that this will give you an edge in the market, I believe it will because I trade it across all markets and it's a very consistent way to trade. Like anything in trading, it doesn't work 100% of the time, but it works at a high probability factor. So go in and make it your own. Create rules around it. I've given you some direction on create some rules, but there's definitely an opportunity to create rules around this that are very binary, cut and dry. Very focused rules that when something happens, you're either out of that trade or you're in that trade. You're either entering a trade or you're exiting a trade. Very simple rules. And if you follow those rules, you'll be well protected in developing a system around something like this. And you're not always going to get it right. Look, you're never going to get all your trades right. But with something like this, and you develop and make the idea your own, you're going to have more right trades than you have wrong trades. So that's the way to look at it. The other thing I would suggest is subscribe here on YouTube if you're not subscribed. If you have any questions in trading as well, you can leave a comment down below. You can join Discord. I'm active every single day. Look, I'm a full-time trader, so full-time trader. I answer questions consistently in my group. I'm there every single day, so I'm always around. So if you want someone that is actually trading the markets, sharing their trades, sharing what they're doing, sharing new thoughts, and really cutting down the BS and a lot of the trading stuff that's out there, that's kind of where I position myself, or I'm at in the trading world, just so you know. I hate talking BS about things that I don't believe work. To me, it's about each person developing their own edge so that they can pull capital from the market. So that's really the philosophy and how I run YouTube here and how I run my groups. All right, I look forward to seeing you in the next video.